Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Dear viewers, in today's video, I am going to talk about how to assess valuations of growth companies and 3 small cap high growth stocks that deserve to be on your watch list. But before that, I would like you to participate with me in a simple stock picking exercise. Consider two companies, A and B. A is a clear market leader in the lubricant space, which is kind of a mature industry. B is a growing company in textile space, which is a highly competitive industry. This is what the financial profiles and the valuations of these companies look like. From a scale, return ratios, margins, dividend payouts, and balance sheet perspective, company A seems to be a better candidate than B. Now, assuming that both the candidates are able to maintain their respective dividend policies and high returns, if I ask you to consider a horizon period of 9 to 10 years, which stock would you choose? It is obvious that despite healthy financials, be it their profit margins or return ratios, none of the companies look cheap. You can choose to not pick any or make a choice, and we will see how your selection has performed in the next few minutes. Well, if you're already feeling that you have enough data to make a choice, you have a lot to learn in the field of investing. At this stage, a diligent investor would want to know the competitive intensity, management track record in terms of execution, and potential growth rates that the businesses could witness. Since lubricants is a mature industry, let us assume the earnings of company A, which is a market leader, to grow at a CAGR, that is compound average annual growth rate of 6% over the next 9 years, assuming this year as the base year. For the textile company, the best case scenario is 19% earnings growth. Does this info make any difference to the choices you made? Well, you can still switch your selection and stay with your options. And this is how you have fared in the real world. If you picked company A, that is a market leader in lubricant space, you would have ended up with a loss of 21% over 9 years. If you picked company B, that is growing textile firm in a highly competitive industry, your return would be 1084% over 9 years, that is a CAGR of 32% over 9 years. If you picked none of these options, considering that a P of 38 times was expensive for stock B despite its decent fundamentals, 32% CAGR would be your opportunity loss as well. In case you have not guessed yet, the stock A is Castrol and the stock B is Page Industries. In the table, you see the base year is 2012, that is December 2012 for Castrol, and March 13 for Page Industries as per their financial reportings or annual results. While I'm recording this, over the 9 years, the P of Castrol has fallen from 31 to 15 times, while Page Industries' P multiple has expanded from 38 to 81 times. The reason Page has done so well is because it had a runway in an underpenetrated organized segment in India and a management team with strong execution capabilities. Castrol, on the other hand, despite being a decent business, is severely limited by the lack of growth opportunities in a mature market. The example of Castrol underscores the importance of margin of safety in businesses where the balance sheets and returns look strong. Page Industries, on the other hand, is a classic example that is proof of wisdom shared by Charlie Munger. That if a business earns 18% return on capital employed for 20 or 30 years, even if you pay an expensive looking price, you will end up with a fine result. It is also a case study that makes us see the moats in a new light. Moats are seen as some kind of competitive advantage that helps a business march ahead of its peers and allows high returns on capital employed over the long term. While speaking of moats, most investors only consider the legacy moat. The concept of legacy moat applies to companies that enjoy leading market shares and earn strong returns on capital, but are not able to find opportunities to deploy incremental capital at similar high rates. In other words, these businesses have a solid competitive position that provides healthy profits and strong returns on capital, but deploying additional capital in their own business is not possible or it provides poor returns. As such, these companies tend to redistribute most of the profits that they earn in the form of dividends and buybacks. This is often the case with companies that have reached a mature phase. Companies such as Castrol that enjoy 20% market share in a mature lubricant market represent legacy moat. It's a market that is growing hardly at 2% CAGR, and such companies cannot help you with multi-bagger returns. As a long-term investor aiming to nail some of the best investment stocks, what you really need to assess in a business is reinvestment mode, something which Page Industries has fared better in. Reinvestment mode applies to companies that find opportunities to deploy incremental capital at high rates and hence their stocks are likely to compound at a higher rate. The renowned value investor Chuck Akre uses a unique construct to identify potential compounding stocks, the three-legged school. It evaluates business on three important aspects. The first is business model, second, management quality, and third, and most important, is reinvestment prospects. Borrowing his explanation of this approach, the first leg has to do with the quality of business enterprise. Look for businesses that earn high returns on capital, on owners' capital. Spend time to understand what is causing this better than average return on capital to occur and whether it is getting better or worse. The second leg of the stool goes to the issue of the people who manage the business. They don't just have to be competent managers, but they have to have high integrity as well. You have to see what is happening at the company level is also happening at the share level or not. Basically, are they treating minority shareholders fairly? And then lastly, the third leg is the issue of reinvestment. This is the glue that holds everything together. That is there an opportunity that exists because of the skill of the manager, the nature of the business to reinvest what we presume is excess cash, and to reinvest in a way that continues to earn these above average rates of return? Once you have found a great business run by an ethical management that has the potential to reinvest its own capital, compounding takes over. Now, as I promised in the beginning, I will now talk about three small cap companies where the managements expect the business growth to be 17% or above and where the return on capital employed is over 18%. Before we go to the names, please note that these are not recommendations but companies to be kept on your watch list. The inclusion in this list does not imply any view. Further, the growth assumption is based on management guidance and is not my estimate and hence needs to be taken with a pinch of salt. The first is Tiger Logistics. Tiger Logistics is a multi-vertical global logistics provider that operates on an asset-light model using the fleet of the carriers it partners with. This is still a young company handling an average of 4,500 TEU per month. While it has exposure to 5 different industries, the biggest exposure is to auto segment that accounts for 79% of the revenue. The rest comes from commodities, yarns, cold chain logistics, defense logistics, and projects in heavy lifts. Its clients include Balkrishna, Piaggio, Hero, HAL, Wrights, Pratt, Seat, TVS, Bajaj, and so on. The company model is concentrated with top 5 clients accounting for 84% of the revenues. While the competition in logistics is intense, its low base and exposure to diverse industries and experienced management suggest a long runway for the company. There are risks related to end industry slowdown, intense competition, and client concentration. However, the management has shown execution capability and the business has shown strong resilience in the recent years amid COVID disruption. The balance sheet is debt free, the return ratios look strong post pandemic recovery. Coming to the growth guidance, the management has shared an ambitious vision to make it a rupees 20 billion company through automation and digitization, expanding geographies, acquisitions in related businesses, and complying to standards of MNCs by opting for green logistics, for instance, the use of electric vehicles. I believe this is a company that deserves to be on your watch list. The promoter stake in the business is 71%. There has been insider selling in the stock in the last quarter, and the pledging in the business is nil. The second on this list is Heranba Industries. The company is in agrochem industry and manufactures insecticides, herbicides, and fungicides. It is a market leader in India's pyrethroid-based agrochem market with over 20% market share. Pyrethroids belong to insecticide group. These are the synthetic chemical compounds that are used to control pests in farm, home, communities, restaurants, hospitals, and schools. 42% of Heranba's revenue come from exports. Top 10 clients account for 25% of the revenue. The client base includes PI Industries, Sharda Cropchem, UPL, Relis India, Dhanuka, Insecticides, Tagro, Sumitomo Chemical, and the company reported a 39% return on capital employed in FY22. In the latest call, the management of Heranba has shared a revenue growth guidance of 15% to 17% with EBITDA margin guidance of 16% to 18% for FY23. The long-term guidance for EBITDA is 18% to 20%. Growth strategy includes launch of new products, entry into regulated markets of US and Europe, increased capacities, and strengthening R&D. The company is working on 15 products at R&D level. Further, for 23 and 24, the capex is expected at 2.5 billion rupees with a turnover of 3.5 to 4 times. The promoter stake in the business stands at 74.87% and the insiders have increased stake in the stock in this fiscal year. The third company on the list is SJS Enterprises. The company is a leading player in India's decorative aesthetics industry and operates from design to delivery stage. Its end markets include auto, consumer durables, medical devices, sanitary ware, and farm equipment. Two-wheelers contribute to around 45% of the sales, and the company's growth has been higher than the growth of the underlying industries. Its client base includes Whirlpool, Stellantis, Continental, Mahindra, TVS, Samsung, Bajaj, and Maruti Suzuki, to name a few. The company is also working with EV makers like Graviton. The company has close to 6,000 SKUs. It has supplied 123 million parts in FY22 and has export presence in 22 countries. Domestic sales in the first quarters comprised 90% of the revenue. The management has shared organic growth guidance of 25% for FY23 and 30% growth in the net profit. This will be supported by new product developments such as in-mold electronics, expansion in new geographies, premiumization or value addition, client addition, and capacity expansions. The company is in the process of acquiring a 7.5-acre land in Pune to expand chrome plating capacity. The target ROCE is 20%. The promoters have 50.37% stake in the company. Despite it being a microcap, the stock is popular amongst the institutional investors, with FIs having a stake of 5.3% and DIs having a stake of 15.9%. The debt is nil. The return on capital employed is 20.7%. I would like to remind again that this video does not attempt to make recommendations, but to educate viewers and make them aware of the opportunities that seem worth tracking. With this, I've come to the end of the video. I hope it offered some fresh insights on how to pick growth companies. Do not forget to like if you found the content useful. Also, do share your feedback in the comment section. For more alerts and such videos, subscribe to Equitymaster YouTube channel. Thank you for watching. Goodbye.